Good afternoon, everybody. Thank you for taking time out to listen to this podcast about using captives to fund long-term care insurance coverage. I'm Karen Landry, managing partner of Spring, a consulting and actuarial firm that works in the healthcare space, both with providers, payers, and employers around various issues, managed care liability, ACO, reinsurance transaction, transactions, as well as employers' risk around certain insurance products. And with me, I have Mike Demansky. And Mike, do you want to say a little bit about yourself?
Absolutely. Great. Thanks, Karen. And hello, everyone. And my name is Mike Demansky. I'm a partner with the Honigman Law Firm. I am the leader of our insurance tax practice. I'm one of a group of attorneys that solely focus on captive arrangements, and we have captive clients all throughout the United States. And we have, in terms of our offices, I'm based in the Michigan area, but we have offices in Chicago and DC as well. But all familiar with various different domiciles and different types of models that could be put to use in different types of alternative risk financing structures. So happy to be here today to join in this podcast.
Yeah, and I should just say I'm located in Boston too, but like Mike, we have captive clients all over the country and work with all of the various domiciles. So what we'll cover today in this presentation is provide you with some of the long-term care market dynamics, in an overview fashion. Then we'll talk about some of the regulatory updates. What are some of the trends that even, that are causing people to take a look at, could they use a captive as part of a solution to address some of the risks around long-term care? And then we'll talk about opportunities for the future, linking long-term care and captives together. So just to jump into the long-term care market overview, if we take a look at the historical environment long-term care has functioned in, beginning in 2002, there were about 102 companies selling standalone long-term care policies. And, over the course of time, the baby boomers have aged, and some have taken out private long-term care coverage, but most have not. When we fast forward to 2012, just 10 years later, the 120 companies have dwindled to 20 companies writing policies, with really only 12 in the marketplace. And nowadays it's even less. So, what, as a country can we do about solving the long-term care crisis that's emerging on the horizon? Well, some states have begun to enact legislation really to address this issue. And there's been a bit of a long-term care resurgence. Long-term care companies recognize the market opportunity, and they've coupled long-term care insurance with life insurance or critical illness insurance in order to make it more financially stable. But even so, there's still only a handful of companies addressing the current marketplace. Next slide. So why do the carriers leave the market? I think it's important when you look at the history to figure out how come so many carriers left the marketplace. Well, pricing restrictions, states have to approve rates, and some states haven't been approving the rate increases that the carriers feel are necessary. One carrier recently submitted an 89% rate increase request to a state, and they only got a 30% increase approved. So you can see that over the course of time, if you're having to live with something you feel is inadequate, your only choice is to close your block of business and leave the marketplace. There's also been a reduction in investment rates of return for fixed income. Although it's on the upswing now, rates have come down over the past decade. And if an insurance company is investing their assets to try and meet the returns required on LTC, they have to bridge that investment gap. And one of the things that's creating the investment gap are the cost of living adjustments. For example, you can still get policies with a 5% cost of living increase year over year. As a carrier, you have to figure out, where am I going to get that 5% return? Also, with the baby boomers aging, what's happening is carriers also thought there'd be more lapses on long-term care policies than there have been. And that's causing, a higher take-up rate with the baby boomers aging with a lower lapse rate. So more people, whoever has purchased a long-term care policy is keeping it in force, and therefore some of the profitability they associated with the book of business isn't there. So generally, those are the reasons why carriers have decided to leave the market. So there are very few traditional long-term care policies in existence. It's more common, as I mentioned, to see them as a rider on a life insurance policy, where an individual will receive a portion of the coverage as death benefits, some paying for long-term care expenses. Some states, Washington State is the only state that's passed legislation on long-term care benefits, and we'll talk about that in a minute. But captives can be a good solution to the long-term care marketplace. And they can do that because there are less investment restrictions typically on a captive, and captives have always been a good tool when coverage is unavailable or unaffordable in terms of implementing something that changes the market dynamic and increases the availability in the marketplace. So, as I mentioned, Washington became the first state to adopt mandatory state-run insurance program. There's been a lot of challenges to it. There was a class action lawsuit that failed. Industry groups looking at how can they take advantage of this legislation, and many carriers are considering their stance. But overnight, what it did was it made carriers sit up and take notice that if you participate in the offering, which either requires you to contribute taxes to a fund or to provide individual or group long-term care coverage to your employees, or be levied this tax, it really was a market maker for many insurance companies. Other states started to take notice, like California, Illinois, Michigan, Connecticut, really looking and putting long-term care on their agenda to figure out how they could address it, perhaps differently than Washington, but address it nonetheless. And I mentioned the dynamics. It's pretty startling to realize that 70% of Americans will need long-term care services over the course of their lifetime. And, $8,000 a month is the median long-term care cost. So if you go into a facility, naturally, some areas are more expensive, some are less expensive, but that's a pretty startling figure. And on average, the typical stay is about 2.4 years, with a little bit longer for females, up to 2.8 years. Setting the bar at 3 years of long-term care coverage as a minimum. So when we look at it from a provider perspective, and many of the states are interested because long-term care coverage, part of it's provided through the Medicaid system. After someone has spent down their assets, in a long-term care facility, Medicaid covers nursing home and at-home care and so forth for individuals with a certain economic level. When you consider that a bed in a typical nursing home costs $93,000 and change for a shared room, or $105,000 and change for a private room, it's not too hard to see why people cannot really afford those levels of coverage. At the same time, there's a crisis brewing because certified nurse assistants who furnish the bulk of care are only making $14 an hour, and you can make that level of income at McDonald's these days. So there's also a staffing shortage if we don't figure out a way to address the problem. So, and COVID continued to exacerbate this. In March, at least 174,000 people died because of COVID in nursing homes and other long-term care facilities. As we've been saying, the trend is that by 2030, 14 million people will require long-term care, and it's going to swell to 24 million. On the liability side, long-term care facilities have long time used captives to handle their liability needs. And COVID, certainly we saw elder abuse and neglect, across the system. There are a lot of excellent long-term care facilities out there that want to take control of their own risk and manage that risk, to try and mitigate those claims and mitigate the insurance costs that are currently being paid by facilities. So this dynamic has really been driving, as I said, states to consider what they might do with regards to long-term care. And one of the reasons for that is that the state budget, if you look at the Medicaid budget, often makes up a considerable amount of a state's budgetary program. And so with this headwind, or tailwind, more likely coming along with the baby boomers aging, the increased need for long-term care coverage, with nothing in place to pay for it, states can begin to see that that the Medicaid system might be the payer of last resort along these lines. So if we go to the next slide. So the Washington Cares Fund was the first to try and make long-term care affordable. And it provided a program for their state residents to get up to $36,500, intended to cover long-term care, home care for 20 hours a week. Well, as I just said, it's well below the average for an in-home nursing stay. At least it's something, and you can use it for facility services. As an individual, if you don't have a long-term care policy, you're going to have a payroll tax of 0.58% on all employees without an income cap, unless they have private insurance that covers them. So many employers have been moving in the state of Washington to provide that coverage to their employees. There are exemptions, and these are some of the things that they paused the program until 2023. Because there were queries about workers who lived out of state, military spouses, immigrants, and so forth, that how they would be handled, and not wanting to leave that population behind. That's still under consideration. But I think putting a stake in the ground, much like we see with paid medical family leave act, we believe that long-term care may accelerate across the country because of the burgeoning need for these services. In fact, California has developed a task force to take a look at creating a partnership between the government and industry to serve their long-term care population. So the California Partnership for Long-Term Care coverage is aimed at having that collaboration occur between public and private entities. They're still on a path in the task force of moving this along, but they're contemplating whether they'll have an employer tax or whether or not individuals will have to purchase private policies. So more to come on the California front. Massachusetts hasn't considered, as far as I'm aware, program at this point in time. But what's happened is with Medicaid managed care, you can see that the providers in a community, whether it's a healthcare system, a provider payer model, a primary care model, in any case, there's a lot of risk bearing, provided through the entities, whether it's a provider, a health plan, a physician group, and these are leading towards governmental officials at least considering the fact that perhaps some of the long-term care needs to be addressed in a different way. And the different models, as you can see over the course of time, this the managed Medicaid marketplace has been in existence for several years now, and quite a number of members have signed up through these models to get coverage and care. And for Massachusetts, as an example, the cost in 2018 was about $16.5 billion, comprising over 40% of the state budget. And this is not atypical. I looked at Massachusetts because that's where I'm from, but it's not atypical when you take a look at what percentage of this governmental spend is spent on things like Medicaid. And conversely, if we take a look on the next page, we will see some other opportunities for long-term care and captive models. As I mentioned a little bit earlier, long-term care makes up about 9% of the Medicaid spend in any budget. So when we thought about this, we've had some clients come and talk to us about, could they use a captive to do this? Could they use a captive in conjunction with the state in terms of developing a risk pool for their constituents? We've also talked to healthcare entities, both for-profit taxable entities, non-profit tax-exempt entities, long-term care facilities that want to control their own destiny by offering a prepaid program in their marketplace, much like the way HMOs developed for prepaid healthcare. Healthcare systems with proprietary health plans that all, not only focus on commercial, but governmental plans like Medicare and Medicaid, community care organizations, and employers who have limited choices for long-term care coverage, and many other organizations looking at how can we address this opportunity in the long run. And the types of risks that they're looking at are really the risks assumed through Medicare and Medicaid, including the ACO contracts, managed care liability coverage, and the risk around long-term care coverage, perhaps most directly for employers. So with that, I'm going to turn it over to Mike to talk about, if you were thinking about doing this, what kind of captive vehicles could you incorporate and leverage, again, depending on where you sit and what your interest is.
Okay, great. Thanks, Karen. And before we sort of get into these models, I think we won't be getting into a lot of the real detailed sort of tax concepts, but for the benefit of the group as we work through these models, we thought it might be a good idea to still kind of do a bit of a level set and sort of as a real quick refresher on some of the tax principles, because that'll help us as we work through models, and it'll help to demonstrate why some of these models, there's always challenges from a tax perspective in terms of trying to find the right fit for a group. And by at least working through some of those concepts, it'll be helpful as we contemplate each of these models. And one thing from a federal tax standpoint, which might be kind of curious to those outside of the tax area, is that unlike most countries in the world that really follow the form of a transaction and the form will govern the tax treatment, in the United States they have this idea of substance over form, where a transaction can be sort of recharacterized from its form depending upon the underlying substance. So for example, something that might otherwise be a sale might be considered a gift. A loan might actually be an equity investment. An independent contractor might be an employee. And so in the insurance world, even though you might have policies and insurance companies, there is always the opportunity for a court or the IRS to recharacterize that transaction and say, you know what, this looks like something else. It's not insurance. It doesn't meet the four primary elements of insurance for tax purposes, which include things like risk shifting, risk distribution, and so forth. And so therefore, it's important for parties to sort of understand that unless it's a transaction is structured properly, there may be implications for the insured, the insurer, the owner of the captive, things that were not contemplated there at the original part of the transaction. And these kinds of ideas need to be built in to ensure that the objectives of the group are achieved. You know, like for example, there was a time when the IRS sort of made the distinction between first and third party risk, saying, you know what, first party risk can never qualify as insurance. It's just all part of one family, economic family, and third party risk could qualify. But as the tax laws evolved, there's been this more of this notion of these four elements of insurance must be satisfied regardless of whether the group is the parties involved are excuse me, first party or third party participants. So I think in terms of the next considerations here, we have some ideas that we think that any party looking at potential models for a group, they should consider some of these ideas. For example, are the parties or are the coverages, are they considered to be first party or are they third party? Is the transaction be treated as insurance or self-insurance from a tax standpoint? And maybe I'll stop there for a minute, as you know, for Karen and I to sort of think about why could there be a case where something could be either first party or third party? You know, there's certain types of coverages and plans that you look at, is this coverage or is this risk really a risk of the employer, or is it the risk of the employee? And is it something that is some separate from the employer, and is the employer just facilitating coverage for a insured? And I don't know, Karen, if you have any sort of thoughts or comparing these types of coverages to other analogies that might be helpful, just to help, you know, a group sort of consider where this might fit.
Yeah, so I mean, I think you bring up, is it a business risk or is it a risk to a third party? I think part of that analysis should include the underlying exposures and who really, you know, where's the real benefit going? And I think, you know, depending on who underwrites, you know, who the policy is underwritten for, obviously, if it's long-term, you know, a fronted long-term care program, where the employer is taking the risk for the benefit of their employees, it would be viewed, you know, like an employee benefits risk, not an employer liability that they're being, you know, reimbursed for. Conversely, if it's ACO coverage, it may or may not, you know, depending on whether or not all the risk resides at the, you know, at the entity that the contracts with. You know, in some instances, healthcare systems may have for-profit physician groups. So you have to look at the facts and circumstances really to make that determination. So
right. I agree. And that's why it's always a sort of a fundamental question, is trying to zero in on the underlying insureds, because that'll help with what makes sense in terms of a potential model. And then we've also have some other points regarding whether these risks should be pooled with the employer's risk, for example, or should be segregated in some way into maybe a separate cell just for this plan. Also, because there may be benefits or possible disadvantages of pulling this risk with other coverages, and perhaps the bundling and the pooling of that risk makes sense to either separate or combine those risks together. And then also, if the sponsor of this plan is a taxable group and a taxable insurance company, whether if they're sort of maybe on the bubble in terms of qualifying as insurance for tax purposes, perhaps adding these types of coverages and risks into the pool can help bolster their position that they've achieved risk distribution for tax purposes, for example. On the next slide, we've just sort of highlighted some of the types of tax issues that can come up. We've touched on this notion of, is it really insurance or is it self-insurance for tax purposes? Do you have enough pooling of risk if the group is intending to achieve insurance treatment, is there enough risk distribution? If the program is with an offshore captive that has not made a tax election to be treated as a domestic company, can there be federal excise tax on the funding? If the sponsor is a tax-exempt entity, could this coverage result in unrelated business income tax? Is always a consideration, as we'll get into in some of these models, that'll be important to a tax-exempt sponsor. If the coverage may be segregated in a separate cell or a PIC under Cayman law purposes, what is the entity classification of that cell? Is it treated as a separate insurance company? That's always an important aspect. And as we mentioned, are there federal tax elections that are available, perhaps to treat the offshore cell, for example, to be treated as a domestic insurance company? So these are all high-level considerations in this area. And in terms of these models, there are, as you know, there are probably many different models. We tried to focus on the more common and the more stable type of situations, as opposed to perhaps more complicated, whether it's group captives, maybe reciprocals, and other more complicated. Try to at least keep to the basics, and because even the basics have some complicated aspects. So that was been our focus, to focus on 3 sort of captive models, knowing that there may be others, but for purposes of this podcast, we're going to focus on these primary ones. So the first model we have is a taxable captive. And in this situation, you'd have, a for-profit parent company or a group of owners that own a captive, and that captive provides coverage to affiliates within the group. And then this idea is whether the group would like to sort of bolt on a plan and perhaps pool the plan as part of the other risks that might be in that captive. Under this model, the idea would be that in the for-profit space, that this plan makes sense to bundle as part of the other risks, and also may achieve additional diversity and abilities to bolster the position that there is pooling from a tax perspective. And under this taxable, the key features of this model would be that the captive would be subject to federal income tax. Any dividends on profits generated by the captive could be subject to a second level of tax, depending upon the owners. If the owner of the captive is a corporate entity, then oftentimes dividends within a corporate group are not taxable until they leave the group. If the parent is more of a pass-through entity, then those dividends can be subject to tax as they are distributed out to the owners. And that's why many times in these cases, rather than paying dividends, oftentimes groups will use the surplus and the profits to help fund additional coverages, which may be, in a situation like this, adding a plan to this group might make sense, because the coverage of that plan will require more surplus and more equity. And therefore, rather than paying out dividends to the group, they can be reinvested into the captive to provide that buffer to provide this coverage. And it's also, go ahead.
Sorry, Mike. I thought you were taking a pause. What I was going to say is, so when I look at this model, I think about, this could be used by an employer or a physician group or a health plan. Those are the typical taxable parties that you might see that would be interested in a transaction, although they might have different risks, whether it's the ACO risk or whether it's the long-term care coverage direct risk that they might want to fund.
Absolutely. And in a situation like this, of course, whenever you're in a taxable space, in terms of some of the 4 elements of insurance we talked about before, it all does put more emphasis on the premium determination that's charged to the captive, making sure it's at an arm's length basis. It's always an important aspect, as well as operating the captive as more like a commercial insurance company in order to support the position that should be treated as an insurance company for tax purposes. So in this space, those are the types of key aspects to be considered. Now, this next model is more of in terms of a protected cell structure. It's sort of a combination of the model 1, where everything is one taxable insurance company, everything's pooled. And in the model 3, which we'll get into, is where you have, again, a bundling within one entity, but the different types of transactions are treated in a different way from a tax standpoint. Here in Model 2, it's sort of in some ways almost the best of both worlds, where you have different cells for different purposes. And in this situation, the idea would be if you have sponsors of a protected cell captive, you have the sponsor owning the general company, or otherwise known as the core, but then separately have different cells for different purposes and different coverages. And so in this case, rather than bundling this coverage for the long-term care in with the rest of the risks of the sponsor and its affiliates, you'd segregate it into a separate cell, and also so that you can insulate any ups and downs of the risks of this cell from the other coverages.
And more, I think we're seeing clients adopt a structure like this. For example, if it's an employer looking at offering something to their employees, they want to kind of keep it separate from the P&C coverages that they have, especially if it's a new line that they're getting underway. So they have a little bit of experience with regards to that.
And I think here, perhaps one downside whenever you have cell structures in general is maybe more from a capital and funding perspective. I think in larger bundle programs, parties like to be able to take the profits from one line of business to help offset this other coverage, as well as not requiring additional capital. And I think that's one thing whenever we see with our clients, whenever their cell structures, they're always concerned about, well, there's costs, of course, with every cell, separate cell, different, financial statements are required, audits and so forth, but also capital is always a key aspect of these cell structures, because in some ways, these additional cells are almost like separate standalone entities in many respects. And therefore I think you lose the sort of the upside of bundling, but at the same time, you are protecting the other risks from any potential downsides from the costs and liabilities of this cell.
Yeah, agreed.
And I think in terms of the final model, this is probably one of the more complicated ones. This is Model 3, where you have a tax-exempt captive. Because in this, even though the tax-exempt captive sort of model is maybe in some ways a little bit of a bit of a misnomer, because the tax-exempt aspect is really at the sponsor level and probably at the level of the other affiliates of that sponsor. But the captive itself, in most cases, especially in an offshore context, the captive itself is not tax-exempt, but is able to structure its transactions with its sponsor and its affiliate, so to sort of limit the taxes that could be imposed. There's the transactions usually are structured such that the captive avoids having a U.S. trade or business, for example, so it's not taxed at its own level. The policies are structured in such a way that they do not satisfy the 4 elements of insurance, as we mentioned, so it's treated as self-insurance from a tax standpoint to limit the application of federal excise taxes and unrelated business income taxes. But now, when you have this plan, this is where you get into this question of, well, is this structure going to be more of a split structure where you have the primary parties are treated as non-insurance for tax, but it's possible the coverage of this plan may be treated as insurance for tax purposes. You have the split structure, and how do you achieve this bundling of disparate types of risks and coverages so they can coexist, perhaps by using the self-insurance funding and profits to help subsidize or at least help with the funding of the plan coverage, but at the same time keeping them separate so that you don't mix or taint the non-insurance with the insurance coverages.
Yep. And I think, I was just going to say that, some of our clients that want to achieve the tax exempt features that Mike's laid out, sometimes for accounting purposes, we might have it qualify as insurance to give less to eliminate variability, in results. So as opposed to just having things flow through as is. So you can combine those two concepts and achieve that.
Right, and if the transaction is still more of a split structure, the positives of an offshore captive in many cases that even if a bulk of the transactions are not insurance for tax, if there's a portion that is considered as insurance for tax purposes, that portion is allowed to still deduct loss reserves in addition to losses paid, which can help from a UBIT tax computation perspective. Of course, federal excise taxes can still apply, but there still can be this duality within that one captive to sort of limit the tax that would be imposed on the self-insurance portion. Now, there's always a question of how large is the true insurance portion if the plan qualifies insurance. And so that's always important to sort of be mindful of whether the true insurance portion sort of takes over. And if it's too large, that can affect the portion of the business that would otherwise be treated as non-insurance. So combined together, it's always important to keep an eye on the size of one business over the other. And if it gets too large, sometimes parties will then restructure the arrangement into the cell structure to sort of continue to insulate the self-insurance from the true insurance portion. So I think with that, Karen, I think we've covered a lot of the key models. And I think, in terms of sort of, I don't know, talking points and next steps and sort of takeaways, I think we've sort of highlighted the sort of the business objectives and the changing marketplace and some of the challenges, but also the opportunities available with captives. I think some of this is really working. The strength is an important, the importance of a strong feasibility sort of study, working through these metrics and dealing with all the consultants on the team to determine what model would work best for the group.
Yeah, I agree. And I think, what we really wanted to do is highlight, let's watch this space, because as the marketplace continues to evolve, the baby boomers aren't going to stop aging and stop needing this coverage. So just as the traditional insurance marketplace is trying to do, I think captives can rise to the occasion and provide coverage that perhaps some of the traditional markets are struggling to do so at this point. So
absolutely.
Thank you for your time. Have a good day.
Thank you.
End recording.